One. And we are live with Chris from BMT Tax Depreciation. Chris, how are you?
I'm very well, thanks, Jazz. Thanks for having us along today.
It's a pleasure having you, and obviously a brand that we would love to align ourselves, and a great brand out there, BMT, and a lot of investors and landlords especially love your brand. So excited to have this session today with yourself.
I'm excited too. I always like, I don't know, preaching about depreciation. There's a lot of misinformation out there. But I mean, even before that, a lot of people just plain don't know that it exists, and then they go see their accountant, and all of a sudden they're in a mad scramble to get one of these things. And so it's good to have a bit of information before you get to that stage.
Exactly, and I'd love to touch on that perhaps at the end of the Q&A,
Yeah.
if you remember. Why? What are the implications? What are the issues the landlords or rental providers can actually face if they leave it till the end as well? Because they've gone through a journey of say 5 or 6 years of holding tenure, and then all of a sudden they realize they need one done. What could go wrong? But I'll let you start. Tell us a little bit more about yourself and your company.
Sure. Well, my name is Chris Pelagi. I've been with BMT for a bit over 10 years now, and BMT itself has been around for 25 years. So in that time, it is an organisation that has grown from being 3 people working out of a back room of a house back in the late 90s through to a nationwide company of about 200 personnel all told. So we've grown a lot in that time, and the reason we've grown a lot is because we provide the leading depreciation schedule in Australia. So I suppose the best place to start is just a quick explanation for those who are unfamiliar with the concept of what depreciation and a depreciation schedule actually is.
Correct.
Yeah, well, here we are. So if you don't know what depreciation is, I think the way that I like to get into it as an entry point for people is it's like if you use your car for business, and you will need to keep a logbook of that car. You know, how far have you driven? You know, you keep your petrol so you can claim that as well. And then when you get to do your tax return, you find that you can claim a tax deduction based on the imagined wear and tear of that vehicle. And for a car, it's simple. You put in your kilometres logged and the type of vehicle, and the ATO software will tell you what your claim is. When it comes to investment properties, it's a little bit more complicated. There are so many rules, lots of eligibility criteria around not only the owner investor themselves, but how old is the property, how long has it been rented for, all of that sort of thing as well. So, but it is still a tax deduction based on the imagined wear and tear. So the idea is that while your property is appreciating in market value, you can claim this depreciation, a representation of the wear and tear, and that will give you some tax relief in the meantime. So don't confuse the appreciation of market value with the depreciation of the building. And it's really important to claim it. It is, for most investors, the second biggest deduction that they have on their property after the interest repayments there. Yeah. We like to call it hidden cash flow as well, because it's what's known as a non-cash deduction. You buy your property, you order a depreciation schedule, and unlike, say, your management fees or repairs and maintenance, you don't have to keep spending money to claim the deduction. You get that document and it sets you up for up to 40 years.
Oh.
Now, the other obvious question, particularly for those new to the game, is who are we? What's a BMT? And we are a quantity surveying firm. A quantity surveyor is a construction management specialist who specialises in estimating construction costs. Now, there are a few reasons why you might need a quantity surveyor to estimate costs for you. You might need a replacement cost estimate for insurance, or you're planning a development and want to secure funding for it. We don't do that stuff. We specialize only in the depreciation schedules.
Right.
And yeah, the tax rulings are really specific. about it has to be a quantity surveyor. Every time that somebody buys a property, it needs an estimation of construction costs. And that's the starting point for the depreciation claim. That's how we come up with our figures. We're not accountants. In fact, accountants are our biggest referring sector. We work with your accountants, so we're a symbiotic relationship with them. And over the years, over the 25 years, we've become really adept at not just working out how to estimate those costs, but how to estimate them up high, because the tax office doesn't say, these are the values you need to claim. The tax office gives us the framework, and we can set the values as long as we can justify them. And it's all about finding that sweet spot where we can justify them just high enough before the ATO tells us we're being a bit silly about it. So we've got to be aggressive, but within reason.
Correct. Yeah. That's an interesting one as well.
Yeah. Now, to start with, we'll look at a case study. Now, I know this is probably not the purchase price in your area. In fact, believe it or not too long ago, this was the median house price in Australia. That's why we used it. It's gone up a bit since we put this slide together, and probably going to keep doing that. But that's not important, if I may say so. So the reason that's not important is because what really matters here is the common scenario you've got there of the income versus the expenses, where before this owner does their taxes, they're down in that first full financial year of ownership to the tune of about $9,700. So that's a common scenario because it is negatively geared and making a loss before taxes. So regardless of the rent per week and the purchase price, this example is a pretty universal example because of that factor of that kind of loss in the first year. The loss could be greater, it could be smaller, but the principles that we're about to look at are going to work out more or less the same. So, and you're going to have to forgive me for bringing maths into it, but it's hard to but what really matters here is there are dollar signs in front of those numbers there, and this is all about money saved. So say that investor goes into the tax return, $9,700 down, they can claim that as a deduction. Now, we use the 37% tax bracket for our examples because that's pretty common for property investors. And with this one, if you apply 37% to that deduction, it means that this owner is getting a refund of $3,600. So after they do their taxes, the net cost to own the property comes down to about $6,100. Instead of losing what we saw on the previous slide, which is about $187 per week, after they do their taxes, they are only losing $118 per week, or that's the equivalent anyway. Now, there's something that this owner is not claiming. Care to guess?
Depreciation.
It's depreciation. Very smart. Yes. So we've got here a depreciation claim in the first full year of $15,800 for a new build. That is quite achievable. In fact, it's even more achievable since we put together this slide. Not only have housing prices gone up, but also construction costs have gone up too. So depreciation being related to that, it's quite possible we could even get a higher claim on that house these days. Again, the principles are the same. If you add that deduction onto the existing deduction of $9,700 there, new super deduction of about $25,500. So when you apply the 37% to that, they've got a tax refund now. Instead of $3,600, it's almost $9,500. And believe it or not, the net cost to own the property in this scenario after taxes is $286 in the first year. So that's the equivalent of about a nice cup of coffee per week there. And the difference between not claiming depreciation and claiming depreciation is the equivalent of $113 extra in pocket.
Wow.
So that's going to add up. Yeah. And when you think about it, it's all about cash flow, having money in your pocket. You can do things with that money. You can pay off the loan, which a lot of people like to prioritize. The other thing, of course, is that you can reinvest it, get another investment property with that extra cash flow there, build up more deposit, etc. You can even just spend it if you want. But the point is, yeah, the point is,
so many expenses that have come on, like compliance checks and other legislations that have come in. That money can be used there.
yeah, look, you're right. I mean, any little bit counts. And, being a bit cheeky in the past, I've even sold it to people as, hey, this can easily pay for your management fees. So, win-win. Everybody looks good from that scenario there.
Right.
So, it really is about having that extra money in your pocket that you can do something with. If you don't claim it, you are essentially handing money over to the federal government on a silver platter, because this is a legitimate claim that they expect you to make. And if you don't make it, well, you don't have the money. So it's as simple as that.
Wow.
Now, I guess another logical step to go to now is how depreciation works. And this is where I guess even people who do know about depreciation get confused. And that's because
there's a lot of confusion around. Agree.
So much confusion. And I said before that accountants are our lifeblood in terms of the amount of referrals they give us. Not all accountants are up on these rules because they are so complicated and specific to our industry as well. So most accountants will leave it to us to do this nitty-gritty stuff. I'm not saying that they're all like that. In fact, some of them are quite knowledgeable. I get some questions from them that stump me occasionally. But there is just in general confusion about this, and a lot of armchair critics out there who think they've got the whole depreciation thing nailed down, but they might just misunderstand one or two of the details. Yeah. So this is the main depreciation claim here, which is your capital works allowance. The Div 43 up there is nerd speak. It's tax nerd speak. It's your Division 43 claim.
Right.
People don't need to remember that. What we find is helpful is if we just refer to this is the structure of the building. And when I say structure, it does also include things like cabinetry and fixed landscaping, your bathroom, showers, the recesses, vanities, tiling, built-in robes, things like that. So the stuff that's part of the building, not just your walls and your foundations and the roof.
Right.
Now, for residential properties, these deductions last for 40 years, as long as the works were performed since 1987. So in this instance, this place was built in 2015. We've assessed the structural works at $300,000. You get to claim the same amount every year, 2.5%. And that means that every year between 2015 and 2055, the deductions are going to be at least $7,500. So that is serious. Yeah, it's long-term cash flow. Most people will literally save thousands of dollars in taxes every year from a deduction like that. Now, I say from when the works were performed. I didn't say from when the property was built, and that's because I want to get away from another misconception, was that it's all about the age of the property. It's not. Yeah. So it's not about the age of the property, it's about the age of the works. You can have a 1960s house that's got a good renovation to it, and we can still help people claim thousands of dollars there. It might not be that high, but it could still easily be in the thousands of dollars from whenever those renovations were performed there. So don't fall into the trap of thinking, oh, you can only do this on new properties or near new properties.
Because we get a lot of buyers who are looking for investment property, and they say, well, the property should be, we're looking for something which is under 7 years old, because after 7 years, you can't claim the depreciation.
I've heard all sorts of figures. I've heard 5 years, 7 years, 10 years, you name it. I've heard it. I don't know where it comes from. There is there are fixtures and fittings in the properties that depreciate a little bit more quickly, and that's where some of the confusion can come from there. So if we
Right.
take the other part of depreciation that I was talking about, this is the plant and equipment, or what you would probably more commonly call the fixtures and fittings here, appliances, anything electronic or mechanical in general,
Right.
floor coverings like carpet, vinyl, floating timber, blinds and curtains, light fixtures, smoke alarms, pneumatic door closers, and even the humble toilet seat. Those are all examples of plant and equipment, and they have shorter lifespans from
Right.
uh, generally a few years up to about a dozen years. I'd say the median lifespan is probably about 8 to 10 years for these things,
Right.
and unlike the building works, you can actually accelerate these deductions. So
Right.
this dishwasher that we've got here, even though its lifespan set by the legislation is
Mm.
8 years, you can accelerate the deductions so that you're claiming 25% of it in the first year. So on
Right.
this dishwasher alone, $340 in the first year. And it's always important to remember that we're also including maintenance. Sorry, not maintenance, transport and labor costs to actually
Yes.
get it into the property. My split system air conditioner, the actual unit cost one
Mm.
thing, and then the cost to actually put it into my house.
Installing, delivery,
So
and everything.
yeah, so I'd be mad if I didn't claim
Mm.
depreciation on that amount too. But these are faster deductions, and when you add up, the oven and the cooktop and range hood, you might have
Mm.
$1,000 to $2,000 or more of these deductions in the first year in the kitchen alone, and then you start thinking about flooring and blinds and light fittings, and this can add thousands of dollars extra onto those ones from the previous slide
Mm.
that we looked at. And that's why a lot of people get confused and think, oh, all of the deductions are in the first 5 years, 7 years, what have you. They're thinking of this stuff.
Right.
So, yeah. But then even after all of this, these items run their lives out, you've still got that building allowance that goes for up to 40 years from when the works were performed.
That is really interesting.
Now this is it gets more let's say it gets more interesting. I was about to say it gets more complicated, but for some people complicated is interesting. This is another source of the myths out there around depreciation, and that's because in 2017, as part of the federal budget that year, the government made some changes to property investor perks. It was the same year that they took away people's travel allowance, so you can't, go for a holiday on the Gold Coast or wherever and look at investment properties and claim it all as a write-off. It was that same year they also brought the hammer down on depreciating fixtures and fittings, those plant and equipment items that have been
Mm.
used before in residential properties. So
Right.
this is really kind of nitty gritty fiddly stuff. And in fact, we have a 15-page white paper that we wrote on those changes. We're not going to go through that now, obviously. Don't have
Definitely.
time and send people to sleep. Yeah. But the basics of it is that if you buy a property that has been used before, think of it like a car again. And it doesn't matter if it's used by a previous owner occupier or a previous tenant, or even if somebody moves out of their property to make an investment property, the plant and equipment in there, from the oven to the carpet, has been used before. And that means you can't claim depreciation on it. If you buy a brand new property, if you get somebody to build you a brand new property, or if you buy a second-hand property and then renovate it with new stuff, then you can claim on the appliances and the carpet and
I was
blinds.
about to ask that. Yep. If someone buys a property and they decide to renovate it or add the appliances or electronics.
Exactly. And part of the reasoning for the legislation change was actually to drive and stimulate the building industry, people paying builders for new stuff and for renovations, things like that. So that was part of it. It's not a law that makes a lot of sense when you look into the details of it, but we're stuck with it now. And it is one of the sources of myths that you can't depreciate the old properties. Nonsense. If you look over there on the left, let's assume that in those two columns, it's the same unit. In the first full year on the left-hand side, you get $14,500 in depreciation because you can claim on the building and the fixtures. On the right-hand side, maybe they're the second owner or they lived in it for 2 years before moving out. They can only claim $8,200 there. But I say only, really, that's still pretty good. And not only that, it's going to be $8,200 in deductions every year for another 38 years to round off the 40-year lifespan there. So people would be mad if they didn't take advantage of that. Yeah.
And I guess it then falls down to what the strategy is as an investor. Some investors would prefer to buy in an area where it's close to the school, there's no land available, they can't build a new home. And it works out really well because rather than having a mindset where you cannot claim if you buy something established, and it actually would make sense for someone who's actually getting a property in the location which would appreciate in value. At the same time, they can take benefits of getting the tax benefits, I'd say.
Yeah, for sure. There's always going to be a trade-off, and we do always encourage people to look at depreciation as part of the overall package. I would never, despite my obvious bias towards depreciation and B&T and all that, I would never say that people should make a purchase based only on a depreciation claim. It should be part of the overall consideration, though, because it can really increase the cash flow while you own the property there. And crunching the numbers, I will be getting to that later because we do have a tool that people can use to help them calculate the cash flow there. But yeah, just to sum up this one, look, to give you an example, the average first-year claim on a residential property in the most recent financial year was about $9,000 in deductions across all of our schedules. For the average first-year claim of properties affected by these laws, it was still almost $6,000 in deductions. So, yeah, and then really it just depends on what property is right for you. But the bottom line is that whatever property you end up buying, you should at least look into it. We can give people a preliminary estimate before they say go ahead. We can usually just look at a listing online and see what kind of claim that they're probably going to be up for. And we're pretty accurate with that. We've always got a guarantee too. If we look at some of those older properties and we're not really sure if we're going to get a good result, we can at least double the fee and deductions in the first full year. And that gives most people a positive return on investment straight away. And if we can't do that, the owner can walk away from it. We won't even hit them up for an inspection charge there. We'd rather have them back next time. So the whole thing's at least risk-free to look into, and everybody should be at least investigating it.
That should be part of the due diligence. It's a no-brainer then. I mean, that's a really great business model where you look after the clients, adding value, but if they don't come for
Yeah, look, we're very nice people. We don't want to be shaking people down for money for depreciation schedules that don't make them money. So, correct. Yeah. Couple of examples here of properties that are a little bit older. The one on the right I like to focus on because it was built in 96. So that's after 1987. It'll depreciate until 2036. But then when you think of the amount of houses out there built in 96 that have no renovations to them, that number's pretty small. It might have been renovated 5-10 years ago, maybe even 1-2 years ago. And we can put a value on not only the original house, but add a little bit extra to it because of those renovations. So our depreciation schedule will help people claim on both existing construction and renovations.
Wow.
Commercial properties, I won't dwell on this too much, but it is quite likely that your investors out there, as well as investing in residential properties, they might own a commercial property that they run their business from. And so commercial depreciation is a bit of a blind spot for people. Don't think about all this residential portfolio that you've got and forget about the industrial unit or the office suite that you actually own, maybe in your super fund that you work from as well. We can help you out with tax savings on that too, and it can be just as lucrative.
Wow.
Now, just a few frequently asked questions. I've already covered that we work with people's accountants,
Mm.
but the bottom line is that people shouldn't make assumptions. People should, if sometimes the accountant will say, "Oh no, your property's too old," go to them with a depreciation estimate from BMT. We'll put it in writing for you before you actually order the schedule, and see what they say. And most of the time, the response comes back, well, if that's what they think they can get, you may as well give it a go. Like I said, it's risk-free. There's that guarantee about doubling our fee that we gave before,
Yeah.
and just don't assume that the property is too old either. My golden rule is if it was built after 87, look into a depreciation schedule. If it was built before 1987 and it's been renovated, before 1987 and it's been renovated since, then look into a depreciation schedule.
Right. Gotcha. The, the information that you provided today is literally gold, because I personally meet so many people. They've got different perception to older properties versus new properties, and the fact that something that we learn every day, and older properties are attracting a lot more opportunity for tax depreciation or deduction over the newer property. So you mean to say the older 1980 style flats and units are better investment options from deductions point of view versus a house of a similar age, or?
Look, depreciation claims are like fingerprints and snowflakes. They have so many variables that they're practically all unique. So there's no, what I can say is that the newer the works, the better. So you could have a 1950s cottage with a good renovation done 5 years ago that
Right,
gets more depreciation than a house that doesn't have much renovation that was built 20, 30 years ago.
right.
Units as well. People think, oh, it's only a one better. There's not much that you can claim there. But
Mm,
we can also get them a claim from the common area of the building. So if it's got basement parking and a swimming pool and lifts and all sorts of other facilities, we can build that into the depreciation schedule as
mm,
well.
mm,
So there's no hard and fast rule about what's better,
mm.
but in general, the newer the works, the better, and the bigger the better. But you can see counter examples of that all
Mm.
the time. So they are just general comments.
So, if I may ask you a question, I'm buying a property which is renovated by the owner
Hmm.
3 years ago. They're living
Yep.
in the property, nicely renovated to high standards, versus I'm buying a property which needs renovations. And of course, time, money, resources will go in as well. If
Mm.
I may save time and money, of course, and buy something which is, say, 2 or 3 years old and renovated, what are the chances versus are renovated again? So does it depend on the level of renovation I would do versus what they've done? How would you
Yeah.
justify, and what advice would Chris give to a client?
Look, the clear advantage, and I have to be careful with what I say before I start giving investment advice, because I can only really give it advice around depreciation. But the
Correct.
clear advantage to renovating a property yourself is that you're probably going to be putting in new flooring and new blinds and new appliances. And it's those things that will, if you we talked about how you can't claim them if they're secondhand. If you put the new ones in, you can. Whereas if you buy that property that's maybe only a few years old, it doesn't really matter. You can't claim on those things. So
Right.
if you do renovate and put those appliances and other fixtures and fittings in, you can claim depreciation on those. And
Mm,
that will have the benefit of increasing your short term depreciation in a pretty dramatic sense in a lot of cases. Those sorts of fixtures and fittings can sometimes double or more the claim in the first few years.
right.
Uh, but it depends on what's being put in. It kind of relates directly to dollars spent.
Mm.
So if you put in, cheap appliances, you're going to get a lower level of depreciation than if you put in, quality appliances and, have a kitchen with a high level of finish, etc. There is a direct correlation in that sense. So,
Right.
yeah.
Interesting. And with the FAQs I was reading, I think it's the last question. I'll let you finish that, but the last part is really interesting as well, because we've got investors who move over their management and they've never done it. They're holding the property from last 7 years, brand new property, give or take, house and land package, for an example, or so the property is about 11 years old. They've never done it. What's your advice on those properties, therefore, for the landlords?
Better late than never. So is it ever too late to claim depreciation? Well, sometimes it is. The fact is that our depreciation schedules, if somebody starts, renting a property 11 years ago, however long, that's when our depreciation schedule will start from. The ATO and the legislation does have limits on how far back people can amend their tax returns they've submitted. By default, you can amend any tax returns you've submitted in the last 2 years. In some scenarios, people can go back further than that. And that's really when they start needing their accountant's help. The other thing as well is that not everybody is up to date with their taxes. That needs to be kept in mind too. I don't know how I talk to people who get away with not paying taxes for 7 years and all of a sudden they're facing a massive fine. Well, the good news there is that they'll be able to claim all of those 7 years worth of depreciation. So it's not about our report. Our report's got all of the figures they need in it. It's about how far in each individual scenario they can go back. But even if, say, they've been renting it for 7 years and they can only go back 2 years, that's still pretty good. It's still better than nothing. And
Better
I
nothing.
started off by saying better late than never.
Agree. Yeah. Wow. And what advice would you give to the landlords if you were to give an advice to your friend or family member today? One piece of advice.
One piece of advice is just don't forget about it or leave it to the last minute. My advice to people is that you should start looking into depreciation. I mean, if you've made the purchase without factoring that in, fine. But once people, sign on the dotted line and they're working towards that settlement date, that's really the best time to start thinking about depreciation, because the amount of people, as we were talking about, you asked the last question, the amount of people who leave it too late to claim, and then all of a sudden they're like, what have I done? I talk to those people regularly, and so it is something just not to leave on the back burner. As I said back at the start, it's often the second biggest deduction that people can make, and if you don't claim it, then you are hemorrhaging money in many situations. So yeah.
Wow, that's good. That's good. No, great. Thank you so much, Chris, and really appreciate your time today. I know you're a busy person, and I'm sure our clients and landlords and our community would get really great value out of today's session as well. And if someone wants to reach out to yourself or perhaps requesting for a schedule, how and where do they contact yourself or your organization?
Sure. Well, look, I'll just skip forward a little bit. There are a few other pointers there which I'm happy to send out to you. This is our cash flow calculator. That'll help people crunch the numbers and compare properties. Here we go. There's our contact details down there. I think the slides have been reformatted because we uploaded them to this streaming platform, so that does look a little bit weird down there. But we do have a 1300 number. That's our website there. There's a lot of information on our website. There's a form where people can request a quote, and we'll get back to them in generally the next hour or two if it's during business hours. And of course, yeah, so much information. Our calculators there that people can play around with. And of course, if there are any questions, any of our personnel at those offices can answer them. We service regional properties as well. We have staff all over Australia, so we've got great coverage. And yeah, no matter where your property is, we'd love to hear from you.
That is great. And the number is quite easy, 1300 728 726.
Yeah, and yeah, I think even with that web page looking a little bit askew there like that, I think people get the idea. So
Correct. Great. Thank you so much for your time, Chris. Really appreciate it, and we'll look forward to the next session we will do in the future.
Thank you very much, Jazz. Anytime.
Great. You have a lovely evening, and enjoy the long weekend and rest of the week left.
I forgot about that. Yeah. Thank you.
Yeah. Have fun. Take care.
Thank you. Bye.
Cheers. Bye.